Imagine you owe someone $1 million. Now, imagine that over the next 20 years, $1 million quietly becomes worth much less. The number stays the same, but what it actually buys, gutted, cut in half, maybe more. Here's the question nobody asks out loud. Who benefits from that? Not you. You're still paying back $1 million. But the person who lent it to you, they're getting paid back in money that buys a lot less than the money they handed over. And if you happen to be the one who printed that money in the first place, if you were, say, a government, then inflation isn't a problem. It's a policy. Every few years, inflation spikes, and the narrative is the same. Politicians stand at podiums looking concerned. Central bankers use the word transitory. News anchors explain that your groceries cost more. And the framing is always identical. Inflation is something that happened to us. A force of nature. A side effect of global events, supply chains, oil shocks. Almost nobody explains that for the people running the financial system, a steady, moderate amount of inflation is not an accident. It is the plan. This video is about that plan, how it works, why it exists, and why the version of inflation they sell you publicly is very different from the version they actually need. Let's start with debt, because this whole story is really about debt. The United States currently carries over $34 trillion in national debt. The UK, Japan, France, Italy, same story, different numbers. Every major economy on Earth is running debt levels that, by any historical standard, look completely unsustainable. We're not talking about a household that's a little overextended. We're talking about obligations so large that paying them off in any traditional sense is essentially impossible. So what do you do when you can't pay your debts? You have three options. You can raise taxes, which is politically catastrophic. You can cut spending, which is also politically catastrophic. Or you can slowly, quietly reduce what that debt is actually worth. That third option has a name. You're already familiar with it. Here's the mechanism, and it's elegant in a cold sort of way. When a government issues a bond, let's say a 10-year bond worth $1,000, it's making a promise. Give us $1,000 today. In 10 years, we'll pay you back, plus interest. But here's what that contract doesn't say. It doesn't say anything about what $1,000 will actually be worth in 10 years. If inflation runs at 3% a year for a decade, that $1,000 has lost roughly a quarter of its purchasing power. The government pays back the same number, but the real value? Significantly less. The bondholder got their money back. Technically, in the way that you could hand someone a gift card and say, I paid you back, after secretly spending half of it. This is called debt erosion, or in more polite academic language, financial repression. And it's not a conspiracy theory. It's been documented, studied, and in certain circles, quietly celebrated as one of the primary tools governments used to eliminate the catastrophic debts they ran up during World War II. The United States debt-to-GDP ratio after the war was over 100%. By the mid-1970s, it had dropped to around 30%. The economy grew, yes, but a substantial portion of that debt reduction happened through inflation. The money got paid back. It just wasn't worth the same amount anymore. Now enter the central bank. The Federal Reserve, the European Central Bank, the Bank of England. These institutions all publicly target what they call price stability. And price stability, in their language, means inflation running at around 2% per year. Think about that for a moment. Price stability does not mean prices stay the same. It means prices rise reliably every year by approximately 2%. The word stability is doing extraordinary work in that sentence. Why 2% and not 0? Because 0% inflation is actually terrifying to central banks. Near zero, you risk deflation, which is when prices fall. And deflation, counterintuitively, destroys economies. Because if people expect things to be cheaper tomorrow, they stop buying today. Demand collapses, companies collapse, and everything gets worse. Japan spent 2 decades learning this the hard way. But here's what the 2% target also does, which nobody puts on a poster. It ensures that money sitting still loses value. Slowly, steadily, including the money owed to bondholders, including the real cost of government debt. The 2% target is simultaneously consumer guidance and debt management, both things at once. And only one of those gets talked about in press conferences. Let's zoom into a number that should make you uncomfortable. If inflation runs at 2% per year for 30 years, which is roughly what governments have targeted, the purchasing power of a dollar falls by about 45%. The government that issued 30-year bonds at the start of that period gets to repay them with money that's worth barely more than half of what was borrowed in real terms. This is not a hypothetical. This is the operating model. And here's where it gets particularly interesting. The people who get hurt most by this are the people with money sitting still. Cash savings, fixed pensions, long-duration bonds. The people who did exactly what they were told, saved, planned, held their wealth in the currency of their own country, are the ones who experience the quiet, legal transfer of purchasing power from their accounts to the government's balance sheet. Meanwhile, asset holders, people who own real estate, stocks, businesses, anything with a price that tends to rise with inflation, are largely insulated. Because their assets reprice. Their wealth tracks inflation, more or less. The gap between people with assets and people with savings doesn't just widen by accident. Now you might be thinking, okay, but surely governments don't want too much inflation. We've seen what happens. Weimar Germany, Zimbabwe, Argentina. Hyperinflation is catastrophic. Absolutely. And this is where the performance of concern becomes genuine. Central banks don't want 10% inflation, or 20. They want the Goldilocks number, high enough to erode debt meaningfully, low enough that nobody gets angry, and just stable enough that people keep trusting the currency. The moment inflation becomes visible and painful, it defeats itself. People demand wage increases. Unions negotiate. Savings dry up. Political pressure mounts. The whole mechanism only works when it's subtle. This is why the panic around high inflation in 2021 and 2022 was real, but interesting. Inflation hitting 8% wasn't part of the plan. It was the plan breaking. The fine line between managed erosion and visible crisis had been crossed. And the response, aggressive interest rate hikes, emergency messaging, chair of the Fed on television looking appropriately grim. Was the system trying to push inflation back into the useful zone? Not eliminate it, just domesticate it again. There's another layer here that almost never gets discussed. Governments don't just benefit from inflation through debt erosion. They also benefit through something called bracket creep. In many countries, income tax brackets are set in nominal terms, meaning in specific dollar amounts rather than in real, inflation-adjusted amounts. When wages rise with inflation, workers drift into higher tax brackets, even if their actual purchasing power hasn't improved. They're not richer, but they owe more in taxes. The government collects more revenue, in real terms, without ever passing a tax increase. Without a single vote. Without a single press conference. It just happens quietly every year. And then there's the effect on borrowing costs. Moderate inflation, especially when it runs slightly above the interest rate governments are paying on their debt, means that governments are borrowing money in real terms for free, or even at a negative real rate. They issue bonds at 3%. Inflation runs at 3.5%. They're being paid in real terms to borrow. None of this means governments are villainous. These mechanisms weren't invented in a back room. Most of them emerge from necessity, from the wreckage of wars and depressions, as the least bad option from a menu of terrible options. And for large, complex economies, some inflation genuinely does serve useful purposes beyond debt management. It gives central banks room to maneuver. It discourages hoarding. It keeps the gears of commerce turning. But there is a significant difference between that honest accounting and the public narrative, which consistently presents inflation as something that happens to governments, rather than something governments, at a moderate level, actively cultivate. When a central banker says, "We are committed to our 2% target," that target isn't a ceiling. It's a destination. 2% is what they're aiming for, not the most they'll allow. Every year at target is another year of quiet, legal debt erosion. Another year of bracket creep. Another year of real returns on savings quietly disappearing. So what do you do with this? The honest answer is that most individuals have limited power to exit the system entirely. The currency you earn, the country you live in, the taxes you pay, these are largely fixed. But understanding what inflation actually does, structurally, changes how you think about holding wealth, about the risk of sitting still, about why the advice to save your money has never accounted for what saving in a currency that's managed to lose value is actually doing to your future. It also changes how you listen to inflation news. The next time you hear that inflation has ticked up to 2.3% and the central bank is monitoring the situation closely, you can read between the lines. 2.3 isn't a crisis. For a heavily indebted government, 2.3 is Tuesday. The system isn't broken. This is what working looks like. Here's the question worth sitting with. If moderate inflation, is this useful to governments? If it quietly transfers wealth, reduces real debt, and generates tax revenue without a single vote being cast, then what would it actually take for a government to genuinely want inflation to go to zero? Think about it. If this video changed the way you see money, hit like and subscribe. More videos like this every week.